welcome to the special edition of the India View with me, Tanveer Gill. My guest today on the show is none other than Mark Mobius of Templeton Asset Management, and he joins me to discuss his India outlook in detail. Mark, it's great to have you on the show. Thanks very much for taking out the time. Now, let me begin by reflecting on an earlier interview that you gave me in December of last year, where you'd said that the GST passage would make you double your investments in India. The India weighted stands at 7.5% in your EM fund. China and Hong Kong collectively stand at 18%. Does that mean that now, with GST becoming a reality, that the India weightage would actually go up to 14% or beyond in the fund, which is sized at $2.2 billion?
There's no question, yes, we would increase India. But you must remember, this GST implementation has been slower than expected. As you know, we're about 1 year behind schedule. That's not a huge problem. We knew there were going to be barriers to implementation, but we would like to see full implementation. And during that process, we, of course, will be increasing our weighting in India, provided, of course, the valuations are attractive.
Right, Mark, but does that mean that, yes, it's pretty much on the cards that you would slowly and steadily increase the India allocation to 14% or even beyond?
It could be as much as 20%. It could be much higher than 14%, but it would be step by step. You wouldn't see like a giant step within a few months. It would take time.
Right, but on that very point, under the GST Council, the government has committed to getting GST off the ground by 1st April 2017. So is the implementation process playing out as per your satisfaction?
Not really. It's taking longer than planned. Now, we did expect difficulties, of course, and we understand that the government has real problems in getting all the states on board. So I think we have to expect another year of implementation. And of course, during that process, we will see the impact on earnings of companies, and that will attract us more to increase our weightings.
Mark, do you think that given the reforms passed this year, whether it's a GST bill, the bankruptcy code, opening several sectors for FDI, managing twin deficits, keeping the growth trend at roughly 7.5%, not talking, of course, 8% plus, maintaining inflation within the RBI's comfort zone, do you think that with all these measures, at this juncture, India as a secular sovereign story deserves a ratings upgrade?
No question about it. India does deserve a higher rating. And interestingly enough, the opening up of the corporate bond market will be very, very interesting and probably very critical to the development of the capital market in India.
The reason I ask you that, Mark, is because Fitch, Moody's, S&P are keeping India at the lowest level of investment grade with a positive outlook. Now, given that forex reserves are at an all-time high, new funds are flooding into the Indian market, bank NPA issues are being tackled, hasn't India's creditworthiness, credit quality at the sovereign level improved, making India one of the safest investment bets in a volatile world?
I absolutely agree with that. I believe that India deserves a higher rating. But you must remember, the rating agencies tend to be slow in their implementation of new ratings. They tend to take a very cautious stance, probably too cautious. But I believe that India does deserve a higher rating.
Sure. Let's talk valuations. Do you feel that the Indian benchmark, valued at 16, 17 times forward earnings, is not expensive but pushing at the upper end of the valuation range where the upside seems to be capped? Or given the liquidity rush, India could close the year well beyond 9100 on the Nifty, which is beyond the all-time high?
Well, I think in the opening of the bond market and the fact that right now bond rates in China, for example, are much lower than those in India means that a wider distribution of bonds will begin to lower the bond interest rates in India. And of course, that directly relates to what the price-earnings ratio of Indian equity should be. So lower interest rates in India will drive higher valuations for corporates in India.
Sure, but with that PE expansion plus, the gush of liquidity which is flooding the markets, do you think that the upside from here is fairly strong for the Indian market? I
believe so. There's a good possibility of that happening. As you know, this low interest rate globally, the global market now is looking at very, very low rates. Even if some of the central banks are beginning to think of raising rates, for example, the U.S. Fed has been thinking about that. But nevertheless, even if they do raise rates, it won't be by very much. And we're still looking at very, very low rates. And of course, if you look at rates, you must do the reciprocal to calculate the PE ratio. So if the rate is 1%, the PE ratio should be 100, and so forth. So we can expect higher PE ratios going forward.
And when you're talking about that PE expansion, in lieu of interest costs going down, earnings expansion coming in, how much can that take the valuation of the market up by? If you're at 16, 17 times, how much PE expansion do you expect?
It could probably go up to 20, 25 at that level in a relatively short period of time if all the numbers are in place and if this GST implementation moves faster.
Wow, Mark, at 20, 25 times forward earnings, you're looking at a target on the Nifty between 10,000 to 13,000 over the short and medium term. And that's a fairly strong upside from the current levels. Is that the kind of appetite that can, fuel the markets higher from here?
Yes, I believe the Sensex and the other industries will move above the all-time highs.
Right, and drilling it down to earnings then, because that's where the correlation lies in determining the kind of returns the market can give annually. What earnings expectation would you work with for FY17, FY18 in local currency terms? And you've largely had a steady currency. Do you think 12 to 14% earnings growth this year is feasible?
I believe so, and actually it should be at the higher end of that range. I believe that you're going to see 14, 15% even if things fall into place.
Right. Let's move on to your sector preferences then. You think pharmaceuticals, given the US FDA image transition, has been an opportunity for investors. What about technology then? TCS and Infosys, they're facing headwinds on client budgets. It's spiraling down to mid-caps as well within the space. Can an investor be contrarian in the technology sector right now, where the broad view is avoid for the medium term? You are holding your conviction when it comes to the technology space. Why is that?
It probably is contrarian because, as you know, the information technology sector has not been doing very well lately. But longer term, we believe they will continue to hold a very dominant position globally and will expand that position. So going forward, we will continue to be invested in the information technology area. I believe the other area, once GST is implemented and other reforms come into place, some of the hardware manufacturing will move into India. Right now, as you know, India is not doing very much in that area, but we believe that eventually this will happen, and that will be very bullish for the technology sector generally in India.
Okay, so just to be fair, you are keeping your confidence in TCS and Infosys?
Yes, that's right.
I also want to talk about the financial sector. I read somewhere that you've been cautious on the space. What's the outlook for the financial sector? PSU Banks are going through a revamp. Private bank credit growth is expected to come back. NBFC expansion is a big theme that's playing in the market. Are you wary of the bad loan situation?
Actually, we have a reasonably high weighting in ICICI and some of the other financial institutions. So we're not wary of the financial sector in India at all because, after all, if India is growing at 7, 8%, the banks are definitely going to benefit from that. And as I said, with the liberalization of the bond market, this could be very bullish for the financial sector. So I wouldn't say that we're shying away from financials at all.
And within your portfolio, I believe you like PSU Banks quite a bit. So you have really been able to cash in on the rally that we've seen in PSU Banks over the course of the last 3 months.
Actually, our holdings in state-run banks is higher than in private banks. So we believe that state-run banks will continue to do well. And of course, there's a certain degree of security in holding state-run banks.
Mark, you've you've called the Reliance Jio entry a game changer. Where will it create the opportunity? Could it support Reliance Industries' earnings? I mean, incidentally, the stock also hit a 7-year high, pushing the upper end of the range that it's been quoting within over the last 7 years, going past 1100, 1120. Most on the street, most investors want to avoid the sector because right now it seems like, given the telecom tussle, the telecom war, the pricing war that's on, it could come at the cost of profitability being impacted for the key telcos, even though it's, of course, good news for the final consumer.
Well, I think now that Reliance has the infrastructure in place and now can drive prices, I believe they will be very intelligent in handling this issue to ensure that they don't end up with a tremendous loss-making segment of their portfolio. So at the end of the day, once they get the market share that they want, they will lay off these price cuts. And the good news, of course, is that this will spread the connections to a wider audience, and this will benefit the industry generally, not only Reliance. So I believe this is a game-changing situation in India and will benefit not only the economy, but the telecommunications generally.
So that's, of course, your broad theme sector-wise when it comes to the Indian market. But I also want to talk about the one pocket of interest that has made you a lot of money over the course of the last 5 years. You have been very big on small cap companies in India. In fact, the $1.2 billion Templeton Small Asian Companies Fund has outperformed the MSCI benchmark by a huge margin. The 5-year return has been 47% versus 12% given by the MSCI benchmark. That is just splendid. And your top holding in the portfolio is Bajaj Holdings. Firstly, run us through the rationale of how you became so big on the small cap story in India.
Well, first of all, in the small cap sector, you have a situation where good companies that are growing, have a much greater upside because they're starting from a low base. So the percentages are in your favor when you're starting that low base. Secondly, a lot of these companies are exposed to sectors which we find very difficult to access in the large cap arena, particularly the consumer arena. So it's a wonderful opportunity, and one of the reasons why I believe the small cap fund has done so well is because we've been pretty heavy in consumers. In addition, we're finding many new opportunities that have not been uncovered by the rest of the industry. By having analysts on the ground, we're able to uncover companies that are really special and can do tremendous things going forward. And of course, growth rates can be very, very high.
Yeah, and can you quickly talk about the top holding in the fund, which is Bajaj Holdings and Investments? It's essentially a holding company and investment company focusing on earning income from dividends, interest, and gains on investments held. As a holding company, BHIL, of course, holds strategic stake in Bajaj Auto, Bajaj Finserv, and Maharashtra Scooters. So your rationale for investing in this one?
I don't want to talk too much about individual stocks, but let me just say this. Bajaj has the advantage of being exposed to consumers and the financial sector. And these two areas are fast growing in India and will do very well going forward. So they're sort of in a sweet spot.
All right, not talking stock specific, but I need to highlight that Tata Chemicals is also one of the top holdings in the fund. Is the specialty chemicals business a draw for you?
Definitely. Going forward, we believe that particularly Tata and other companies in that arena are going into more specialized, higher margin products, which will be very profitable going forward. So I believe they're in a very good situation going in that industry.
You know what's also interesting about the Asian Small Companies Fund, Mark, is that the top allocation is India with a weightage of 27% versus 12% that India holds in the MSCI benchmark, which is more than double. It's more than China, South Korea, Hong Kong. Does that mean that India is your favorite market when it comes to hunting among small cap companies and finding quality small cap companies to invest in?
Well, you know, that's the exciting thing about India, because you've got thousands of companies out there that have not been discovered by the regular investors. And this is a wonderful area that we want to target. India is probably the most undiscovered small cap arena anywhere in the world. And that's the reason why we're putting more and more effort into that area.
So basically, despite the risk profile, despite all that concern about high promoter stake, you have faith in the quality of small cap companies in India, and perhaps more faith in small becoming big in the Indian market versus the rest of the region in Asia.
Yeah, it's very interesting because once you delve into some of these companies, many of them family controlled, you find that their integrity is very high. In fact, I would say in some cases the integrity of the smaller companies are better than the bigger companies because the bigger companies have all kinds of other forces that they have to deal with. So once you dig into some of these companies, it's quite gratifying to see how they're run and the fact that they're operating their businesses on a very high ethical level.
Okay, let's talk macros. On the macro front, do you expect more rate cuts from the RBI under the new Monetary Policy Committee model?
I believe this will happen, yes. Particularly, as I said, with further liberalization of the bond market and liberalization generally in India, this will tend to drive interest rates down. I was saying that if you look at further liberalization of the bond market in India, if you look at a further opening of the capital markets in India generally, and reform, the tax reform, this will all tend to drive interest rates down. And this will be very good for India. There's no reason why rates in India should be higher than those in China.
Also, before we wrap up, Mark, I just wanted to touch upon some global issues as well. You feel, and you've been an advocate of how helicopter money would perhaps be a prudent policy measure to be adopted by the Bank of Japan, the Japanese central bank, sooner rather than later, as it would work its way into creating more demand in the economy and being really the solution for the demand deficit. It may stoke inflation, but that is something that the Bank of Japan either ways has been working towards. So is that really the solution one should be looking for? And is it only a matter of time that they would adopt this strategy?
Yeah, the helicopter money, I was referring to Japan specifically. They're running out of options, and that's probably one path they have. The problem that you're facing globally is central banks are asked to be the drivers of economic growth, and they don't have that capability. It's reform and government actions that will result in better growth and lower in situations in these companies. So I believe that going forward, they're going to find out that the central banks cannot do all of this work. It must rely on governments to make the reforms necessary so that companies can operate profitably and can grow.
Right. And also, EMs have had a great year. It's been a great 2016 for EMs versus developed markets, especially the second half. Will this be your favored trade into 2017 as well? Do you think that this resilience, this outperformance for emerging markets can continue?
With this situation, with lower interest rates globally feeding into emerging markets, I believe first of all, emerging markets will continue to do better. And secondly, the global economy will do better if this kind of situation goes forward. The only constraint now is the fact that with rates that are too low, people will tend to not want to put money in banks. And then you get into a riskier investment situation. But that's another story.
Right. And so what is your view, Mark, on the big event risk that stares us about 6 weeks down the line, the US presidential elections? It's a binary event and can make markets volatile through November and December. I mean, we've seen that play out with Brexit too. So how are you positioning your portfolios to account for who wins in the upcoming elections?
At the end of the day, if you look at the statements by both parties, you'll find that they're not that different. Both want to encourage economic growth in the U.S. Both want to have more government spending. One of them wants to lower taxes. So the differences are not that great. Maybe Trump being a little bit more aggressive in the tax arena. but I don't expect a seismic problem for the markets, regardless of who gets elected. I think going forward, the situation as regards to interest rates is really more critical.
But do you think, Mark, your optimism on emerging markets would get challenged if the Fed were to move faster on rates in 2017? I mean, we were expecting one rate hike in December. That seems like a clear possibility. But going into 2017, if they were to be more aggressive and hawkish, would that make you rework your overall EM outlook?
We've done studies on the relationship between U.S. interest rates and emerging markets performance. And at the end of the day, there really is no good indicator that this is a straight relationship. In other words, sometimes interest rates go up, the market goes up. Sometimes interest rates go up and the market goes down. There's no formula for determining what will happen. So I would say at the end of the day, small rate increases will not have the impact that a lot of people think it will have. So I think emerging markets will continue to grow. Higher interest rates will not be a big constraint, because we must remember the low interest rates in America has not really fed back into emerging markets to any great extent yet. Now, this is ongoing, and we believe, for example, in India, this will happen, and it will happen in other emerging markets. And of course, low interest rates in the individual markets will have a positive impact.
What do you expect on rates? Do you expect a rate hike in December and then the Fed being hawkish through 2017, maybe 2 to 3 hikes for the year?
I think they're going to be forced into doing something. As you know, the Fed governors are somewhat split on their opinions, and you could see a small increase at the end of the year. But I don't think this is going to be very significant.
Right, and amidst all this global economic uncertainty, volatile global market environment, do you think India will continue to exceed expectations and stand out within the emerging market group? Will continue to be an outperforming market into 2017 as well?
I believe so. I think India is going to be very strong and probably will surprise a lot of people with its growth and also its reform agenda.
Sure, and that would be a key reason for you to keep increasing allocations to India. Mark, thanks very much for taking out the time to speak with us. Really appreciate your views as always. With that, we come to the end of this special edition of the India View with Mark Mobius. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.